Hello my dear friends and welcome to StudyIQ. I am Joycey Joy and today in this lecture we would be continuing our Prelims exclusive current affairs series on Indian economy. So we have already started with Prelims exclusive current affairs series. We have completed lecture number 1 and 2. So this would be lecture number 3. And in the first module we have started with banking and financial sector. So this will be lecture number 3 on first module, that is banking and financial sector. So our plan would be to cover the entire current affairs based on Indian economy for the past 15 months for your upcoming UPSC preliminary examination, which will be on 2nd of June 2019. So we would be covering all the current affairs regarding Indian economy in 10 lectures. So this is lecture number 3 and this would be the last lecture in the banking and financial sector module. So for the previous videos, please refer to our YouTube channel. You can find the previous 2 lectures. Now let us start with the third lecture on banking and financial sector. But before we begin, this is our channel StudyIQ and we are providing pen drive courses for various competitive examinations including SSC and bank courses, UPSC optionals, SSC JE courses, teaching examination, railway examination, defense examinations, RBI grade B, NABARD grade A, UGC NET, UPSC Civil Services Examination, CLAT examination, state PSCs and also for various professional courses. You can visit our website www.studyiq.com for more details or you can call to any of these numbers for more information. Let us start with the third lecture, module 1, that is banking and financial sector. So as I told you, this will be lecture number 3 in the banking and financial sector. In the previous 2 lectures, that is lecture number 1 and 2, we have covered 18 topics, that is 9 topics each in one lecture. So today we would be covering the rest of banking and financial sector in this lecture. And in this lecture, we would cover the rest 13 important topics in banking and financial sector. So let us start. Let us start with T-bills or treasury bills. Now, what is meant by T-bills or treasury bills? Treasury bills or T-bills are short-term securities. So, remember they are issued for short-term. They are short-term securities issued by the Reserve Bank of India. So, T-bills are issued by RBI on behalf of the Government of India. So, basically, T-bills are issued by RBI on behalf of Government of India and these are used in managing short-term liquidity needs of the government. So since T-bills are short-term financial instruments, the financial instrument is used to manage or meet the short-term liquidity requirements of the government. Now T-bills can be for 91 days, for 182 days or for 364 days. So maximum period is 364 days. So this is short-term because period is less than 1 year. Now regarding the return on T-bills, T-bills are issued on discount to the face value. That is, suppose the T-bills is for 100 rupees, the issue price would be 90. So it would be issued on discount and after maturity the face value, that is 100 rupees, would be paid to the investor. So T-bills are basically issued on discount to the face value and the holder will get the face value on maturity of the T-bills. And the return on the T-bills is the difference between the issue price and the face value. So here the issue price is 90 and the face value is 100. So the return for the investment or the return to the holder would be the difference between the face value and the issue price. That is 10 rupees in our example. And therefore the return on T-bills will depend upon the auctions because it is issued on discount. Now, who can purchase treasury bills or T-bills? Any individual, firms, trust, institutions and banks can purchase T-bills and also the commercial banks and the cooperative banks, they can use treasury bills or T-bills for fulfilling their SLR requirements. SLR requirement is statutory liquidity requirement. So, in order to maintain their SLR levels, the cooperative banks or commercial banks can use treasury bills as an instrument. So, this is a very important point to be remembered. So you should know what all are the instruments or what all are the components of SLR. So one component can be T-bill or treasury bill. Now another important feature about T-bills is that it can only be issued by the central government in India. So no state government can issue treasury bills. So this is very important. You should remember this. No state governments can issue treasury bills. It can only be issued by the central government. And also the secondary market of the T-bills is very active, which means that there is a high degree of tradability with T-bills. So these are the important points that you should remember about treasury bills. This is very important from your UPSC preliminary examination point of view. The key things that you should remember about the treasury bills is that it is issued on discount, and at maturity the holder gets the face value. Secondly, it is issued only by the central government. It is issued by RBI on behalf of the government. And these are the important things to be remembered about the treasury bills. Now moving on, next one is IPPB. It's a very important topic. IPPB is India Post Payments Bank. Now, India Post Payment Banks has been launched, and it will focus on providing banking and financial services to the poor people in the rural areas especially. So, regarding IPPB or India Post Payment Banks, things to be remembered for your preliminary examination. It is a public sector company. So, meaning it is owned by the government. So, it's a public sector company owned by the government, and very important feature of IPPB is that 100% equity is owned by Government of India. So, it is not that the majority shares are held by government, but 100% of the shares of India Post Payments Bank is held by the Government of India, and it comes under the Department of Post and Ministry of Communication. So, IPPB comes under Ministry of Communication, and within the ministry it comes under the Department of Post. So, 100% equity is held by the Government of India, and it is governed by Reserve Bank of India or the RBI. Now, important facts about IPPB. IPPB started its operations on 30th January 2017. It had opened 2 pilot branches. The first branch was opened in Raipur and the second one in Ranchi. So, it was on a pilot basis. And IPPB or Post Payments Bank would be offering a 4% interest rate on savings accounts. So, savings will attract an interest rate of 4% in Indian Post Payments Bank, and it will also offer many other financial products like savings account, current accounts, money transfer, direct benefit transfer, bill and utility payments, merchant payments, etc. Now, in the context of IPPB, let us understand what is Payments Bank. So, Payments Bank is also a very important topic for your UPSC preliminary examination. So, let us understand what is Payment Banks. So, Payment Banks are non-full service banks. It means that it does not provide all the services that are provided by a normal commercial bank. So, they are non-full service banks, and their main objective is to accelerate the financial inclusion. So, Payments Bank aim to accelerate or improve the financial inclusion in the economy, and these banks will have to use the word payment bank in its name so that it can be differentiated from other commercial banks. So, the most important thing to be remembered here is that it cannot provide all the services which are provided by the other normal commercial banks. Now, regarding the capital requirements of a payments bank, the minimum paid up capital for payments bank is 100 crore. Now, coming to the leverage ratio, the leverage ratio should not be less than 3%. So, what is meant by leverage ratio? Leverage ratio means how much capital comes in the form of debt. That means the ability of a company to meet its obligations. Now, the leverage ratio should not be less than 3%. So, leverage ratio means the ability of a company to meet its obligations, and it should not be less than 3%. Now, regarding the promoter's contribution in case of payments bank, the promoter's contribution should be at least 40% for the first 5 years. And regarding foreign contributions or foreign shareholding, the foreign shareholding in the payments bank would be as per the FDI policy for private sector banks. That means it is amended from time to time. So, there is no fixed foreign shareholding policy, but it depends on the FDI policy of the government, which changes from time to time. Now, regarding SLR, that is statutory liquidity ratio, apart from CRR, that is cash reserve ratio, payments banks also needs to maintain SLR. So, this is a very important point because there is every chance that UPSC can ask you a statement whether payments bank needs to maintain SLR and CRR. So, you should remember that apart from CRR is mandatory. So, apart from CRR, SLR also needs to be maintained. So, SLR is statutory liquidity ratio, and payments bank will have to maintain a statutory liquidity ratio, and under statutory liquidity ratio, they need to invest minimum 75% of its demand deposit balances in SLR, eligible government securities or treasury bills. Now regarding the scope of activities of payment banks. So we will see what are the activities wherein the payment banks can involve. So payment banks mainly deal in remittance services, and also they can accept deposits of up to 1 lakh. So deposits of up to 1 lakh can be accepted, and they mainly deal in remittance services. And even though they can accept deposits, they cannot lend to the customers. So as we have discussed in the SLR, 70% of its demand deposits needs to be maintained under SLR. So they cannot lend to the customers. Instead, they will have to deploy their funds in government papers and bank deposits. So they can accept demand deposits, but they cannot lend. And payment banks can issue ATM cards or debit cards, but not credit cards. So these are some important points that you should remember about payment banks. And they can also involve or deal with simple financial products like mutual funds or insurance products. So these are all allowed for payment banks. So these are the important points to be remembered here. Now moving on, let us understand banking ombudsman. What is banking ombudsman? Now first, coming to the current affairs, the Reserve Bank of India has tightened the banking ombudsman scheme, and the objective of RBI is to strengthen the grievance redressal mechanism for the customers. Now coming to the new guidelines provided by RBI, RBI has issued new guidelines saying that a bank having 10 or more outlets should have an independent internal ombudsman in order to examine the customer complaints. Now let us understand more about Internal Ombudsman Scheme of 2018. The Internal Ombudsman Scheme of 2018 mandates banks to grant a fixed term of 3 to 5 years, which cannot be renewed to the Internal Ombudsman. So a security of tenure, that is minimum 3 to 5 years fixed term, has to be provided to the Internal Ombudsman. And the Internal Ombudsman can be removed only with the prior approval of the RBI. So the commercial banks needs to take a prior approval from the RBI if they want to remove the Ombudsman. So the Ombudsman Scheme of 2018 covers appointment, tenure, the roles, the responsibilities, the procedural guidelines, and the oversight mechanisms for Internal Ombudsman. And the implementation of the scheme will be monitored by the bank's internal audit mechanism. So basically, RBI has issued guidelines in order to strengthen the grievance redressal mechanism for the customers. So Ombudsman has become more powerful body with more responsibilities and roles. Now they have got security of tenure as well. Now regarding banking ombudsman, who is a banking ombudsman? So it's a quasi-judicial body. And this quasi-judicial body is created to resolve the customer complaints against the banks relating to certain services provided by the banks. So Ombudsman is a senior official who has been appointed by the Reserve Bank of India in order to address the grievances and complaints from the customers. So the most important thing to be remembered about the banking ombudsman is that Ombudsman covers all kinds of banks. It is not specific to any particular bank. It covers public sector banks, private banks, rural banks, and even cooperative banks. So this is the most important thing to be remembered. Here is where you can have a confusion. So public sector banks, private sector banks, rural banks, cooperative banks, all the banks are covered by banking ombudsman. Next we will discuss about total expense ratio. So total expense ratio is basically the cost that is charged by the investment manager on mutual funds. So basically what is mutual funds? Mutual funds is a pool of savings or investment by different individual investors. So this small investments by different small investors would be used by a investment manager in order to invest it in a larger investment. So the cost that is charged by the investment manager on mutual funds is called the total expense ratio. Now why total expense ratio has become an important current affair is because the SEBI has announced changes to the total expense ratio of mutual funds. So we have already seen what is meant by total expense ratio. So we will see the details. Mutual funds are basically the investments where an investor entrusts his or her money with the investment manager. So there is an investment manager, and as we said, the charge incurred by the investment manager or charge cost that is charged by the investment manager in managing the mutual fund is called the TER or total expense ratio. And this money is charged as a percentage of investment. Now, for the investor, it is important because it is charged or levied on their investment. So, therefore, it will have a direct impact on the returns. So, according to the TER, the returns also will come down. Now, coming to the current affair, we have seen SEBI has changed the guidelines for TER. Now, what are the changes made by SEBI? SEBI has lowered the TER or total expense ratio that a fund house can charge on its investors. So, here a reduction in TER means that it will ensure higher returns for the investors. Now, the next topic is currency derivatives. We will see what is currency derivatives. They are exchange-based futures and option contracts. Now, in simple terms, a person can use a currency future contract to exchange one currency for another at a future date at a price that is decided on the day of purchase of the contract. Now, why is currency derivatives an important current affair? This is because the MCX, that is Multi-Commodity Exchange of India, it is the largest commodity house in terms of market share, and they are planning to enter into the currency derivative segment. That is why it has become an important current affair. Now, for your prelims examination, MCX is important. Let us understand some facts about MCX. So, MCX is basically a multi-commodity exchange, and as the name itself suggests, it's a exchange like BSE or NSE, Bombay Stock Exchange, or the National Stock Exchange, where commodities are traded. So, here the trading takes place in commodities, and this is a platform for commodity traders that will facilitate online trading and settlement and clearing of commodity futures transactions. And this was established in November 2003 under the regulatory framework of FMC or Forward Markets Commission, and later in 2016 the Forward Markets Commission was merged with SEBI. Now, after FMC has merged with SEBI, the MCX will fall under the purview of SEBI. So, this is a very important fact for your prelims. In 2016, the Forward Markets Commission was merged with SEBI, and now it comes under the purview of SEBI. Next important topic is ICA or Intercreditor Agreement. So, here Intercreditor Agreement means that a group of banks or a group of creditors would have jointly given some loans to a person or for an entity. Now, this group of creditors is called intercreditor or the group of creditors. So, the agreement by this group of creditors is called intercreditor agreement. So, intercreditor agreement aims at speedy resolution of stressed assets. For example, if the loan given to a particular entity by the group of creditors, if the loan becomes an NPA, non-performing asset, speedy resolution of the stressed asset is required. So, what will happen? An intercreditor agreement will be established. So, this intercreditor agreement aims at speeding up of resolution of stressed assets, and the eligibility is that minimum of 50 crore or above should have been lended to the entity or to the person. So, here under intercreditor agreement, the lead bank will be authorized to formulate the resolution plan. Suppose a group of 10 banks has given loan to a particular entity. So, there will be a lead bank. Lead bank here means that the bank which has given the maximum loan amount. So, that bank is responsible for coming up with the resolution plan, and it is formulated as a part of Sashakt plan. So, Sashakt plan aims at resolving bad loans, and this agreement or the intercreditor agreement is based on the recommendation of Sunil Mehta committee that looked into the resolution of stressed assets. Now, coming to the provisions of intercreditor agreement, the agreement says if 66% of the lenders by value agree to a resolution plan. So, by value, if 66% of the creditors agree to the resolution plan given by the lead bank, it is binding on all the lenders. And those lenders who have not agreed to the resolution plan, they have an option either to sell their loans to the other lenders at a discount of 15% or to buy the entire portfolio by paying 125% of the value agreed under the debt resolution plan. So if 66% of majority by value agrees for the resolution plan which is put forward by the lead bank, then the resolution plan will be binding on all other lenders. Now this is about ICA and this is a very important topic for your UPSC preliminary examination. Next we will understand what is meant by bad bank. So a bad bank is basically a bank that would buy bad loans from commercial banks at a discount rate and then recover the money from the defaulter by providing a systematic resolution plan or systematic solution. Now let us understand the illustration. Suppose SBI, it's a commercial bank. So SBI has got a bad loan or an NPA or a stressed asset. So this NPA will be purchased by a bad bank. And what does the bad bank do? The bad bank, after purchasing the stressed asset or the bad loans from the SBI at a discount, will recover the money from the defaulter by providing a systematic solution to the defaulter. So here, what is the idea of bad bank? Bad bank is a bank or a financial entity that will purchase bad loans from other commercial banks. So bad banks also work similar to the principles of an asset restructuring company or an ARC. So ARC was set up under the SURFACE Act. So the legal framework for ARC is provided under the SURFACE Act. So ARC or Asset Reconstruction Company also does the same thing. It buys bad loan from commercial banks at a discount and tries to recover the money from the defaulter by providing a systematic solution over a period of time. So here the bad bank also specializes in loan recovery. Now why bad bank is a current affair? This is because the concept of bad bank in India was put forward in Economic Survey 2017. So Economic Survey has suggested bringing up the idea of bad banks into India, even though it's only a recommendation and bad banks does not exist in India right now. Economic Survey has given an recommendation. That's why it's an important current affair, and bad banks are a very good idea for dealing with the bad loans in the commercial banks. So bad banks will purchase the bad loans from commercial banks at a discount rate, and this will give a relief to the issue of bad loans with the commercial banks. That's why it's a very important current affair. Next one is LRS or Liberalized Remittance Scheme. Why LRS has become a current affair is that the RBI has narrowed the definition of relatives in order to check the flow of funds through LRS or Liberalized Remittance Scheme. So we will understand what is a new definition given by RBI. So the definition for relatives has been narrowed. So this relatives definition includes only immediate relatives like parents, spouses, children and their spouses. So the definition for relatives or close relatives has been narrowed by RBI. Now regarding LRS or Liberalized Remittance Scheme, here under the LRS, all the resident individuals, so all the residents can freely remit up to $250,000. This is very important for your UPSC preliminary examination. So the amount is also very important. Resident individuals can remit freely up to $250,000 overseas every financial year for a permissible set of current or capital account transactions. So this money can be transmitted or remitted for a permitted list of current account as well as capital account transactions. So let us see what are the permitted transactions. So permitted is education, travel, medical treatment, purchase of shares and property, maintenance of relatives who are living abroad, gift, donations, all these are permitted. So individuals can also open, maintain and hold foreign currency accounts. Now let us see what all are not permitted. Trading on foreign exchange market is not permitted. Purchase of foreign currency convertible bonds like for example masala bonds, they are not permitted. And also sending money to certain countries and certain transactions are not permitted. For example, people cannot send money to countries identified as non-cooperative by the FATF or the Financial Action Task Force. And remittances are also prohibited to those entities that are identified as posing terrorist risk. So this is liberalized remittance scheme. The cap is very important, and permitted transactions and not permitted transactions are also very important. Next we will understand about small finance banks. Now what is a current affair? RBI has decided to allow urban cooperative banks, UCBs, to convert into small finance banks. So now urban cooperative banks can convert themselves into small finance banks, and this is to bring urban cooperative banks into mainstream banking. So this is the current affair, and based on this we will understand what is small finance banks. Basically, the idea of RBI was that urban cooperative banks were facing regulation from both RBI and also from the state governments. The respective state governments also used to regulate the urban cooperative banks. Now, if they are brought under the SFB or small finance bank category, they will only be regulated by the RBI. So this is the significance and the intention of RBI. Now let us understand what are small finance banks. So small finance banks are those banks which will primarily undertake basic banking activities like acceptance of deposits, and they will also engage in lending activities, but lending activities would be restricted or mainly focused on underserved and unserved sections. For example, small businesses, small and marginal farmers, micro and small industries, unorganized sector, etc. So they are specialized financial institutions that will provide loans to underserved sections or unserved sections. Now let us understand what are the scope of activities for small finance banks. So they can accept small deposits and they can also provide loans. They can also distribute mutual funds, insurance products, etc. And they have to lend 75% of their total adjusted net bank credit to the priority sector. So their priority sector lending is capped at 75%. Now regarding the loans provided by small finance banks, maximum loan size can be 10% of the capital funds to single borrower, 15% of the total capital funds if it is to a group, and minimum 50% of the loans should be up to 25 lakhs. Now with this lecture, we are winding up the first module, that is banking and financial sector. So we will continue this series. Next module will be on external sector, and with a total of 10 videos or 10 lectures, we will finish the entire 15 months current affairs on Indian economy for your UPSC preliminary examinations. You can follow my Facebook page for more video updates and the PDF of these lectures. And also you can write to me on joycey.studyiq@gmail.com for any of your queries or for any of your suggestions. Thank you.